So I'm preparing you for interviews with this industry. And I'm encouraging you to go to the annual report if you can find one. Allstate has theirs, MetLife has theirs. Just there's a few that do. Public companies that have their statutory. They still don't have their 2022 out there. So this is still 2020. I don't know when 2022 would be ready. We used to file everything by March, so you'd think they would have it by now, but they haven't put it out there yet. So last class we looked at the cash flow statement, which is a statement you don't really use in insurance. It's just not that valuable to you. But yeah, underwriting exhibits are really quite helpful because it tells you which lines of business they're in, but it also shows you what line of businesses there are. So fire, I can't say I completely understand fire. USAA does some fire. You would think fire, that's just homeowners, but there are some structures where fire is the only thing they cover. So one of our alums was doing fire at USAA, and I keep trying to find him. I know he's still out there somewhere. Come back and talk, because he was an actuary. He should have what, 20 years. It's been more than 20 years. I still remember a student showing up to my class, and I said, "Oh, your last name, I recognize that name. Do you know so and so?" And he goes, "Oh yeah, that's my dad." And his dad was a student of mine. So he's probably 73 years old by now, but who knows. But allied lines, I can't talk too much on those. I have had students ask me about farm owners. Obviously that's a very unique insurance. USAA didn't do any of that, but you can just tell, you look at Allstate homeowners. So they have net written, we talk about written, so they took on $9 billion. But remember, when they take this on, that's the entire amount for the whole year. So if they write it in December, they're showing all 12 months. But then they set up a liability for the unearned portion of it. So the change in unearned gives you the earned premium. The earned is what actually goes on the income statement. The written is what we use in a lot of ratios. So you can see here, it's pretty significantly different on this particular line of business, a good $500 million difference. They do some commercial, but I don't think Allstate does much at all. They do some inland marine. Most of that's probably commercial. Look how small the earthquake is. Just don't do much, but this is the unconsolidated company. So if I went to consolidated statement, they'd probably show some earthquake. So they probably have a California only company that's where all the earthquake is. They do sell earthquake. Now, accident health is supposed to be on the life insurance side, but there's a little bit that stayed on the P&C side. Why Allstate has this, I don't know. Maybe that's for their employees. Who knows? It's kind of strange that it's there. Credit, accident and health, again, it's health insurance and other accidents. So they have some. It's kind of strange that they do, but it's a small fraction of what their homeowners is. Less than 10%. They don't do a lot of workers' comp. You can see there, I doubt that's just their own, because that's a really small number, $27,000. That wouldn't cover even this company. But product liability, and again, that's commercial. They don't do much of that. And then you get into the auto, the liability and the physical damage. You can see how much of the premium is Part A and how much of it is physical damage. So that's a big part of their business. Here, the two premiums, again, off about $500 million. Physical damage off about $500 million. So the written versus the earned tends to be lower because you write it all up front. Aircraft, you wouldn't expect them to do any aircraft. Obviously, if you're doing aircraft, that's a very unique business. They don't do a lot of the commercial side that you would expect. No boiler machine. Credit, I'm not real sure on credit on that. Sometimes credit, there's credit life insurance, you understand that. So if someone dies, they pay off your bill. So here, this is probably someone totals their car, that this is going to pay off their outstanding auto loan. When I was at the credit union at USAA, they wanted to sell this stuff, and I thought, man, it's just such horrible insurance. That was on the life side, selling life insurance. The premiums were terribly overpriced. The people would have been a lot better off just buying a really cheap term policy. Would have been a fraction of the cost. But they said, we have to sell it because our customers keep asking for it. I said, why do they ask? We own a life insurance company, right? And they can go buy it really cheap. there. So I don't like credit insurance. You're much better off buying the actual product. They do some warranty. I have no idea where the warranty is. Again, very, very small. So if you look at the earned premiums, 35 billion, there's 25 billion of it. There's another 9 billion. So 34 billion of the 35, 36 billion is auto and home. So this is pretty cool because with USAA, I was looking for competitors, and using that SNL software, I could bring in those 3 lines for thousands of companies. I would find those, and my definition of USA's competitors is that auto and homeowners had to be at least 70% of their business. And that brought up like 13 companies. So I could use this particular schedule to pull in that kind of information. USAA is like 99%. You can see for them, it's like over 90%. Then they just have more details of premiums, a lot of details. Premiums written, more details. Direct, affiliates, non-affiliates. And then they get to the losses side. This can be pretty interesting. The same level of companies, but then you notice a few extra lines. We have the medical professionals, some of them, a little more detail on the liability side. Here's where you have direct, which is the business they do, and then the reinsurance they actually assume from others, the business they cede to others. You get all these details. I don't know what just happened to my computer. Yeah, it's kind of blurry, isn't it? Yeah, no, it's not your eyes. So it's completely, the system's completely freezing down. You can get a good sense, it's on a statutory basis. You can get a sense of their profitability for these businesses because you have every one of these lines. I'll show you the actual detailed income statements that they do show here, if this thing will ever work again. Let's see if I can get it. You think of any other industry that provides this level of detail? I don't think banks do anything close to this. All right, it looks like it's frozen. Come on, come on, come on. Is the internet down? Things open. Let's see if Chrome's any better. I don't think Allstate has ever interviewed at UTSA. Did any of y'all know? Y'all ever heard that company or State Farm here out on campus? I'm trying to get more insurance companies to come on campus, and we'll see. We're going to have an insurance day, but because ICT moved their scholarship to the fall semester, I was going to wait till the fall semester. All right, let's see if I can do any better here. So I'm not going to change the size. That seemed to like kill it, but direct reinsurance by all these different lines. You do notice some lines are consolidated here that weren't consolidated before. Some lines are broken out that weren't broken out before, but incredible. And then even the loss ratio over here on the side with some pretty shocking numbers. This is unpaid losses, so the reserves, and then the expense side. So the expense side, you have your claims adjustments, expenses, you have advertising. This is a big deal. Board, bureaus, and associations, that's a big deal. These are companies that go out and get credit reports. They go out and they get accident reports, how many speeding tickets, you know. Equifax was a big one on the life insurance side. I'm not sure what they use on the P&C side, but these are big companies. I have one alum that's working for Equifax. It's really fascinating talking to him about, you know, the problems they have with credit scores and some of the data breaches and those kind of things. But these are huge companies. They tend to be really concentrated because it's all about data, and you got to get a lot of data. Salaries are there, so you can see their salaries. They break out payroll taxes for some reason. other employee relations, would it be helpful to compare this line 9 to line 8 between different companies? I don't know. I don't know how precise they are in breaking these up. Travel, one thing they have to do, which was irritating to me, but they have a schedule. I don't think it's in here, but they have a schedule where they list all travelers for your company from the most expensive to the least expensive. And I worked for a boss that he traveled because USAA let them keep their travel miles. And he took his whole family on vacation with his travel miles. So he was like I kid you not, he was the #1 traveler at USAA. He spent more than the CEO. Now the CEO used the corporate jets, so that's kind of cheating. I was like number 19, and my friends gave me the hardest time, so I stopped traveling. I said, I'm not traveling anymore. This is too embarrassing. He had me traveling so much, and he took first class, whatever you could to get the miles. So yeah, it's amazing the level of detail that they place into these schedules. Rent, equipment, they do have depreciation. So remember this, even though these assets are not admitted, they have to take them off the books, they still show the depreciation as an expense. I don't know why they have printing and stationery. Some of these are from years and years ago, before computers. And then they break out the state taxes. This is not income tax. These are the state taxes. Premium taxes, I don't know where premium taxes are in here, but so some pretty hefty numbers and then some other numbers. So you get you cannot get this level of detail. I've tried with Bloomberg for some companies, and even like Nike, I wanted their advertising costs and I couldn't get their advertising costs. You can get it out of Capital IQ, but if you go into Cap IQ, you don't have this level of detail. The frustration of this level of detail is probably not the detail you want. There's lines on there you don't need, and there's lines you'd like having broken out that aren't in there. And then you have the investment income. So here's where it's talking about. We noticed that their investment income. Can't refresh this page. Let's see, I have two of them going at the same time. See if that can help us. So we noticed something about their investment income. Their investment income jumped dramatically from 1.7 billion to 3.5. So we can essentially figure out why that happened. Is there any one item? And here you notice this one line right here. Common stocks of affiliates. So their affiliates paid some massive dividends this last year. And that was true at USAA as well. The affiliates could one year pay a $500 million dividend, another year pay zero. So that's probably the entire, and that probably, if I looked at this the prior year, it was probably a much smaller number. And that jumps out to you, doesn't it? Versus every other line as being a big jump. So you get that level of detail on a GAAP financial, you probably have a tough time finding that particular number. In fact, that total investment income is probably the entire detail you'll get on a GAAP financial statement. They even break out the the capital gains, unrealized capital gains, so realized gains and unrealized gains. They even break that out. So in a year like 2022, which I wish I could show you 2022, interest rates rose, you see those bonds losing value. We see that here, except for the bonds are carried at amortized costs. So just because rates rise, you may not see it in the unrealized gain, because they show them at now the stocks are at market values, so you can see the stocks there. So here you see the affiliates, they lost 2 billion. Why? Because they pay all those dividends, so their net worth fell. So it's offsetting on the other side, but the unrealized doesn't go through the income statement, it goes through the. So you can see how quickly we can answer the question of why did their investment income go so much? It really doesn't. They just shifted it from the affiliate into a dividend that went up to the parent company. Here's their not admitted assets if you want to see the detail on that. And then you have, I don't know what's in these footnotes, but if you've ever gone to a GAAP financial statement, there are footnotes that are really valuable, and then there's 90% of them that are completely useless. But how do you know which is valuable, which was useless? You have to read through them all. And it's just page after page after page of notes, including more numbers. So Seasons Residential Holdings, purchase business combinations and goodwill. Allstate has goodwill. USA never had goodwill my entire time there. They bought a company that we looked at that I said, there's no way I would invest with this guy. He was explaining to me his prison record and why he doesn't beat people up anymore. And it was like, you're the sole owner of this company, and we're thinking about it. And I was like, yeah, I can't be conscious. Huh? Yeah, but it's like, we're going to put millions of dollars in this company. It goes under, and then they say, huh? Well, he was in prison for quite a while, but so yeah, just look at all this incredible detail. So there's probably something incredibly valuable there, but do you have time to read through all of this stuff? How fast I can look through. That's the notes. I haven't gotten to the interrogatories yet. That's all notes. Or gap notes that long. So you thought, well, that's it. Then you get to the interrogatories. So then you got to answer all these questions. Are any of these questions of any value? I'd be interested, and this is something where SNL would be valuable, is that they change their answer. That I might be interested in. I have to do the tax return for our charity, and it's this kind of stuff. Just list the questions after questions. The first year I went through them all. Every year since, whatever I answered last year, that's what I'm entering this year. I don't even read them anymore. And I probably should. Something's probably changed. So the interrogatories, just pages and pages of those. So there's a lot of detail in here that someone's putting together that I seriously doubt anyone's reading any of this stuff. And all this is getting followed with the states. I mean, look at that. Name a real estate holding company. USA would have something like this. All these companies. Yeah, just massive amounts of detail. And then you get to something that is valuable, which is the 5-year historical. If I were interviewing with a company, I might start with this, because a lot of the data we saw in the previous statements are here, but they give you 5 years of data. You can look at how the reserves have changed, which lines are changing. You get your net income, net underwriting. So you can see they had a bad underwriting year this last year after some really, really good years. The investment gain, we saw that almost double this year, but that's all because of subsidiaries. Total assets, you can look through that. There's the risk-based capital we talked about before, which is another one I would definitely look at and get some sense of, is that improving over time? And any major change. So I would definitely want to know, why did net worth drop? Is it because they pay a dividend to their stockholders? Did they buy some stock back? Did they have losses? It doesn't look like they had losses. We're going to talk about their asset allocation here, but there's a real problem with this. This line 3.1 looks like they have a lot in stocks, but they don't distinguish between publicly owned stocks and affiliates. And you want to break those out. But fortunately, down here, look what they have. They have the affiliates. And do you notice anything interesting here? So you saw those. They had some kind of special one-time dividend come up. At USAA, this was one of my biggest projects. The property casualty company was just getting so illiquid. The USAA was buying all this real estate and their stuff, sticking all this money into the bank. I did a project where we got our smallest subsidiary to pay a dividend. And that guy was so proud of it because he got no respect. And so he ran around to all the other affiliates and said, how much dividend are you paying? Oh, we're not paying a dividend. Oh, I paid 16 million. And just suddenly overnight, we're getting hundreds of millions of dollars in dividends from our subsidiaries. So why Allstate had this happen, I have no idea. Did they sell off a company? We saw 2 billion come from dividends, but that doesn't explain the other 2 billion. Why did that fall 2 billion? So there's something going on there. I would research that more. There is a schedule in here that lists all of those subsidiaries and how their values change. So you can actually figure out which subsidiary it was that happened to. So you can't get that on a GAAP statement. You could never get that level of detail. This would not be possible. So what I usually do is I take this 14.4%. You notice how it's dropped because of the subsidiaries dropping. I would take the subsidiaries out and look at their stock allocation without subsidiaries. we'll talk about that a little bit more. Here's their unrealized gain, where you notice, the big drop. So here's their dividends to stockholders. They do give you that information. That did jump the last few years. So that is probably a big reason why, that's 1.5 billion increase. That's one reason probably the net worth probably dropped. You get some details on losses, on reserves. Loss ratios are pretty interesting here, especially if there's a catastrophe. You'll really notice that jump. You won't notice it so much on the auto line, but on homeowners line, you would notice it. I don't think we have Harvey in here. So something did happen last year, or 2021, but I don't remember what happened in 2021 to cause that to jump like that. Underwriting expenses. This I use quite dramatically at USAA because our expenses were so much higher than all the competitors. And it's just like we can't be having 30% underwriting expenses when Allstate's at 24 and Geico's at 18. So there's some really useful information here. Loss to development, y'all remember that? So here's their loss development. You can see most of them are negative. This last year was the first time you saw a positive. So they're reducing reserves, and then finally they had a one-time catch up. All right. A lot of valuable information. Then you start getting more and more detail on the products and the premiums and the gains and losses. But y'all notice anything stands out on this page? There's one word that's really important on this page. Y'all notice it yet? Y'all notice it yet? That's the state of Alabama. So what does that mean? These are called the state pages. Life insurance doesn't have this, but they have essentially a financial statement for every single state. That would be pretty useful. If you're an actuary and you need someone out, and like, let's say, Elizabeth, you become their Georgia actuary. You might be interested in what all state numbers look like on the homeowners or auto side. And it's by product line. I mean, look at this. Isn't it amazing? By product line, state by state by state, all the way through. So just incredible. You're not going to get that on a GAAP basis. So let's look at Texas. In fact, let's just find Texas if we can. No, that was probably a mistake. Yeah, I shouldn't have done that. All right. So there's the Alabama page. Let's see if I can get down to Texas without going too far. Nope. When you have 700 pages, it's really tough not to go too far. There's Kansas, if anyone's interested in Kansas. Now, why might Texas look really small? I'm not sure that it would, but why might Texas look like they don't do business in Texas? What do we see with the state of Texas when we talk about mold? Anybody remember? Oops, too far. There's Texas. There's Texas. Passenger auto homeowners. Here's homeowners, $2 million. In Utah, homeowners is 8 million. Is Utah a bigger state than Texas? Why is Texas so small? County mutuals, Lloyd's, right? Whatever you can do to get around the Texas regulations. So they probably have a Texas County Mutual. They probably have a few of them. I remember we had one subsidiary we didn't need anymore, and they were going to sell it. You can sell the shells of these companies. It's like, yeah, we need a Texas whatever kind of company. Is like, okay, yeah, we'll sell you one of those. So Texas looks a lot smaller, probably both on homeowners and auto. The autos for $10 million, no way. They got $13 billion to Texas is not 0.1% of their U.S. business. So you probably see the same thing with USAA as well. All right, so there's all the state pages, and not just states, but once you get past all the states, then you get into the Puerto Rico. They don't do anything in Puerto Rico. Canada, Guam is probably in there. Other alien, I don't know what that means. And then a grand total, so incredible details. Schedule F is pretty important. There's a bunch of them, but it's all about your reinsurance. And reinsurance is a big deal. Life insurance has the reinsurance schedules as well, but it's just far more important. So Schedule F, a lot of Schedule F. And again, remember, someone used to have to type all of this stuff. Do you think there's any typos when they typed all this? Because this, if there's anything that's wrong, they have cross checks that tell you. But when someone's typing, you know, can you imagine someone typed and they're on the wrong line and you're like, yeah, no one's ever gonna know. Just leave it. And how do you even type on something like this? I don't. They must have had blank sheets that they typed into. Yeah, a lot of Schedule F. Get to the bottom of Schedule F. Part 4, Part 6. I think we're getting close to the end. Here's the accident and health. This of it is also on the life insurance side, but it's much more important on that side. Health claims. And then you get to Schedule P, obviously the one I love. We've already covered that one pretty well. But again, a lot of Schedule P. If I can get to it. You notice I'm on page 203, so I'm not even halfway through yet. All that Schedule P, warranty, workers' comp, a lot of nuns. I did a lot of Schedule P pulling data because it's just stuff you can't get anywhere else. More Schedule P, more Schedule P. Part 6C. Now, I don't know how much of this existed back in the 40s and 50s, so I'm sure probably a lot of this got added. Some of this is probably not even possible because they just didn't have the data, the computers. 7A. And then they have interrogatories just for Schedule P. That was probably added. All right, I did. Schedule T is another one I would go to first. So Schedule T is a great exhibit. It shows all the premiums by state. So you can see where they're mainly domiciled. This is a really good one to do the consolidated statement. This is just this one particular company. So here you see Texas looks really small. And again, because of the county mutual and all that. What's their biggest state? So California, it doesn't look like they do a lot of subsidiaries in California. Because California is, 10% of their business or even more than that. So these are their gross premiums by state, direct written, direct earned. This incredible detail. What's their second biggest? New York. Wow, New York looks like it's even bigger than California. So they probably do have some. They probably do have some California subsidiaries. Now, if you look at a life insurance company, this line would essentially be zero. Practically every life insurance company has a life of New York because of the state of New York is horrible. That's not true for property and casualty, but New Jersey is. So New Jersey is the property and casualty, what New York is the life insurance side. Do you really think they have no business in New Jersey? Obviously they do. But New Jersey, they'll have a separate company that does nothing but New Jersey. So again, it's form over substance. If you're a lawyer for a life insurance company or an insurance company, and you walk into their office and says, "We need your help," and they say, "What? Okay, we'll start the company. What name you want to call it?" Like they're already thinking new company. My boss wanted to name, I think I may have told you all this before. He wanted to name a company Newco. It's like, we're not going to name a new company Newco because we're going to name the next one. Next Newco. It was like, he was so tired of coming with company names. Yeah, USAA, most of them are real estate related. They had a real estate company for everything. And we ran out of names. Some of them are easy. They have a real estate company owns Lock and Terra, so they just call that Lock and Terra. You know, that's pretty straightforward. But all right, this is the other one I want to show you. Schedule Y. I would definitely look at Schedule Y. The nice thing about Schedule Y is it's the same for the consolidated and unconsolidated. It shows you the entire company structure. So here's where you have the holding company up on top, again, a Delaware company. And then you have all the different pieces in here. You'll probably see a county. There's a New Jersey company there. There's another New Jersey company. There's a Texas County Mutual. There's a lot of Illinois companies because that's where they're mainly domiciled. There's another Texas Lloyd's, a Texas Lloyd. Now, why do they have so many Texas Lloyds? I was really never sure. USA had all these companies. They had like the members and then the relatives of the members, and then they started doing enlisted. So they threw all the enlisted into a company. You know, they had all these different companies. I don't know what the lawyers were thinking. I'm not even sure. Sometimes the lawyers even knew why they were doing something. They said, "We'll just add a new company. We don't know. We'll figure it out later." And then you notice that A, so that means there's more. And then there's C. So each one of these costs money to set up. A lot of them are Delaware. A lot of them are Illinois. Again, I don't know why Delaware is the state to go to, probably taxes or something. Here's all the B's. Now, are there other industries that are this complicated? I don't know. My guess is this is probably one of the most complicated. Now, I'm sure banks have something similar to this, but probably not quite this extensive. I just don't know where you go to find it because we don't have, you know, they're not required to show all of this. You go into the annual report of JP Morgan, you don't know they have 20 companies. You just don't, you just don't know where to go to look for it. But I'm sure they have something similar to that. They're certainly going to have a company for their investment firm. They probably have some breakout for Europe versus the US, those kind of things. But I doubt they have this many companies. And then here's what I was talking about, Schedule Y. Anytime two affiliates do business with each other, you have to file that with the state. And so all those affiliated transactions have to be listed here. So incredible detail. Yeah, just ridiculous detail. It even says detail. So we could probably find that $2 billion in here somewhere as something they did. There's more Schedule Y, more interrogatories, overflow pages, just in case you didn't have enough. Now, we're only on page 281, and we've covered everything. So what's left? The investment schedules. So this is what I went to. Every single investment that they own is listed in detail on here. And that's how I dumped over 100,000 securities from those 11 competitors. I actually did an efficient frontier of all of our competitors. And I did it before and after tax because USA is taxed in a very unique way. So here's a summary page. And in a summary page, you'll get breakouts of affiliates. Schedule BA, Schedule D. Schedule D is the bulk of it. So right down here, they'll show you parent and subsidiaries and what that is. So you get, here's some subsidiaries. So you get some good breakout. The problem up here is this detail is not a useful detail. And the reason it's not a good detail is people aren't real consistent where they put things. So what I wanted to break out was government bonds from mortgage-backed securities, from corporate bonds. I want to break corporate bonds between investment grade and non-investment grade. This doesn't really help you with that. I wanted market value, but this isn't really market value because it's a mixture of market value and costs. So you can't really trust that. They do break it out by country, but it's just US, Canada, and other. But that is somewhat helpful to know other countries. And then I love this schedule. Schedule D, Part 1A. they give you the bonds by credit quality. So right here, current. If you want to know how much below investment grade Allstate is doing, this is the current year, and this is the total. And NAC 1, 2, and 3 are investment grade. 4, 5, and 6 are below investment grade. Now you might say these are NAIC ratings, but they're almost one-to-one match to S&P and Moody's. There may be a little difference, especially if S&P and Moody's have a split rated, but it's almost a one-to-one match. And this is real helpful for me to know. It's more important on the life insurance side, but real helpful for me to know how much below investment grade. I got our CEO to approve below investment grade. And I called investment people and said, he approved, you can do X amount. So they started buying investment grade. They had a default. And he says, they can't do it below investment grade if they ever have the default. And so I had to tell the investment people, no defaults are allowed. So they said, well, we can't do it below investment grade. But one reason I could argue that is our competitors had a good 5-10% allocated to below investment grades. So I could show, especially on the life insurance side, I could show him it's not that uncommon for this industry to have that. But they have all this detail up to there. So you have to go to this last page, and it's not the bottom of the last page. It's this, the top part, the current year. They have it by maturity. That can be helpful. But what I did is I brought in every single bond and got the maturity from that. That was more valuable to me, especially with mortgage-backed securities, because maturity doesn't really help you much on that. Where else can you go to get that level of detail? It just doesn't exist. Let's see, I want to show you a couple more things. Look at here that they list every single security. That's why this is several hundred pages worth of stuff. Schedule A is, I think, real estate related, real estate owned. Schedule B is mortgages. Schedule BA is other assets. And you look at this, that's where you see a lot of like joint ventures, maybe some hedge funds, that kind of stuff. Private equity is probably in there. Schedule BA. I mean, every single thing they own. Now, there's stuff in here they don't want you to know about, but they have no choice. That's how I know exactly which options, because USA was doing options, and I was really curious what Allstate was doing as options. I could get every single one of the options in here. Are they, how far out of the money are they? When did they buy them? We bought, you could see when we bought ours. We bought ours. It was funny. I got us in the stocks in 2008, so that's how stupid. And the market went up, so we were up 9%. And I said, I'm getting nervous, so we got out. Then we got back in with options. We lost 9%, and then we lost more, and then we got out of the options. The market came back, so we ended up with a 1% gain. So I was kind of curious if Allstate did something like that. So we ended up with just barely making money, which is pretty good because the market was down 30-something%. But most insurance companies don't do options, even though they do stocks, and Allstate was one of the exceptions. They're hiding nothing. They could go and see exactly what we're doing, and I could go and see exactly what we're doing. So there's no hiding here. This is all required by law that they report all of this. All your Schedule BA, there's a lot of, and Allstate's pretty unique. They have a huge Schedule BA. I remember that just looking at them. That's probably true today compared to others. Now, why is it so many pages? Because what they have to do, look at the title here. You have a Schedule BA that shows everything you own. Then you have a Schedule BA that shows everything you bought this year. Then you have a Schedule BEA for everything you sold this year. Just ridiculous. Then you have Schedule D. So here's the bulk of it. Schedule D, this is every single bond that they owned. Every single treasury by QSIP. Isn't that amazing? Just no other firm would do something like that. Just how many pages is that going to go? I mean, it's going to go forever, never, never, never. Now, do you think they typed this in the 50s? I think it was, I don't know when. I mean, they had the Schedule D when I arrived at USA, which is when they got their first PC, it wasn't like this is now required. It's like now we're required to do this. Before it was the typing pool. Now we're required to do this. And they just got this all loaded. My first year, they first got this all on a computer. My department had its first PC ever. We used something called Multiplan. Y'all have never heard of Multiplan. It looked like, well, we used Lotus. Y'all have never heard of Lotus. IBM on Lotus. Have you heard of Lotus? Have you ever used it?
No.
No.
I was looked into old stuff. I looked into it always too. Yeah. For IBM.
Yeah. I bought Lotus at home, and I thought, wow, I can't believe I spent $2,500 on a PC, and those years dollars. I mean, it wasn't like I'm not inflating it. And I had to load OS. Then I had to put in like 18 disks of Lotus to load Lotus, and then I could do Lotus at home. 2 hours later, I can do a spreadsheet now. Pretty amazing stuff. With those floppy disks, have you ever seen a floppy disk? I'm not sure what diseases I'm getting from that. There was something in there. Look at all these Schedule Ds. It's amazing. So the Schedule D is every bond they own. That's part one. Part two is every bond they purchased this year. The next part is every bond they sold this year. We're in part two now. Oh no, part two is all the stocks that they own. So in part two, I brought in all the stocks, and I could decide. What I did is I wrote a script to match it up to the S&P 500. So those are my large cap. And then I had to figure out what was US, and then everything else was international. Fortunately, 90% of their stocks were large cap. So I had to manually go through and figure out how much was in there. They didn't do, the 11 companies I looked at did not do much non-US stocks. USAA did. But I didn't have a problem with USA because I knew exactly what we were doing. I didn't have to. But then here's stocks and bonds acquired during the year. There's part three. And they look at that. All these bonds they had to acquire. And if you think about commercial paper, 100% of commercial paper is owned and acquired and sold because it's all less than a year old. So, those go in and out. It's all the same. So they even have one schedule that has all bonds acquired and sold during the year. So you had to put those in a separate schedule. Who's looking at all this stuff? So now this is Allstate. State Farm is much larger than Allstate. So you can imagine State Farm, they do their annual report, and then they have a separate book just for the Schedule D. And it's its own book, and they follow that with the state. They have to use a truck to send it there. Part D is those that sold and redeemed. Yeah, my word. I think that might be the end of it. Part four. Well, there's a part five. There's another Schedule DB. But essentially, that's why this thing is so massive, is all investment related. So 2/3 of this thing, and it's massive because of all the incredible detail. But don't forget that this detail is here. Boy, I got some good brownie points when I went to the USA Executive Council, and I showed them all of our competitors' asset allocation and showed them ours. And our after-tax return was higher than all the competitors, and we were taking much less risk. And I want to demonstrate to them that USA's huge tax advantage means they could get a higher return in State Farm and take far less risk than State Farm. And so we should take advantage of that. Should be, let's do it. State Farm, they were way out on the curve because they had a huge allocation of stocks, and we still had a higher expected return than they did because of the tax treatment of a reciprocal. So anyway, so go out there and don't go through all of these. I mean, I don't think they're going to be impressed that he's like, oh, I saw you bought this bond with this CUSIP and you bought it in whatever year. That's not going to be impressive. But the fact that this exists could be quite valuable to you. All right, so we call that the annual statement, the annual blank, the statutory blank. I think the word blank probably comes from all those typing years. They probably published and then the typist typed into the blanks. But we still call it the annual blank, the statutory blank. So what are some of the key ratios if you're looking at an insurance company? I'm going to show some of these to you in a future class. So we already talked about the loss ratio would be really, really important. And you could see that on the 5-year history. That's in there. LAE ratio is in there. Underwriting expense ratio is in there. I don't know if I would ask an interviewer, why is your expense ratio so much higher than anybody else's? You might ask a Geico or Progressive why their expense ratio is so much lower, but they're direct writers. They don't have commissioned salespeople. That's the reason why USAA should be lower. They have that same advantage. You can look at the investment expense ratio. That's a little bit tricky because there's some allocation going on there, but this is a mistake. I'm going to put this on the videos, so maybe Stuart will watch it. Mistake USAA made is they outsource their investments, and they probably quadrupled their investment expenses. So they had a guy internally doing it for, $1 million or whatever, and they outsourced it to BlackRock for probably $5 million, probably quadrupled. And I'll still talk to the guys. Yeah, they're stupid to outsource that, because he knew the portfolio a lot better than that firm they outsourced it to, and he did it on the cheap, but they outsourced it. I think they outsourced this just because they needed the office space. The combined ratio, very, very important. We talked about that earlier. That's a good ratio to know. You can get the combined ratio out of Bloomberg. The loss development ratios, you probably can't get that out of Bloomberg, but the loss development ratios, I haven't checked yet to see if I can get that out of Capital IQ, so I'm going to be experimenting with that a little bit. But that's how you can look, especially when you look back historically, and see, are they generally adding to the reserves, or are you generally reducing the reserves? And that can give you some sense of how conservative they are. We talked about the state pages. Schedule P we talked about. So we did all of that. Yeah, so we covered Schedule P pretty well. The different type of premiums. So why is that important? Because you want to look and see how significantly they use reinsurance. Is it 10% of their premiums, 20%? Is it mainly on the homeowner side? So that's where we're going to the homeowners page. Firms do some reinsurance on the auto side, but it tends to be on the homeowner side. So yeah, that's the annual report. I'll show you some more when we get into some of the financial analysis of what this industry looks like. Did y'all have any idea this all existed? It's pretty amazing stuff. I loved it. I remember Tim was the one who kept all the annual blanks, and I was constantly going to his office. I need 2010, I need 2007. I knew where everything was, and I was constantly using them. And then finally we got SNL, so I could just grab everything from SNL. There's a good chance if you do an entry-level job on the finance side in an insurance company, you're going to be doing SNL stuff, or even better, your firm doesn't know about SNL and you're the one to ask, and you get it internally, and you can do some incredibly amazing things. We had one intern, and that's what I had him do. He did a great job. Really, I was really impressed. He figured it out. Just really, really interesting analysis. And my question to him is, what are our competitors doing on investments now? What's the maturity? What's the duration of portfolio? What's the credit quality? Because this industry doesn't, and we're about to get into that on the investing side. This industry doesn't know what the other side is doing. The life insurance side does, because investing is central to that. But the property casualty side, no one knows what the other side is doing. So let's talk investing here. So there was one day I was sitting at my desk. I was in the investment company. I'd been there 9 months. I've been a security analyst for 9 months. I get a call and they say, Ron, they're starting a new department at USAA, and they want you in the department. And you can say no, but it'd be the last time you say no at USAA. You won't be working here anymore. So it's essentially been told, you will take this job. I say, okay, I get the hint. I called a good friend of mine and said, Larkin, what should I do? And she said, well, sounds like you have no choice. Okay, just want to at least bounce off of one person I trust. And what that department was supposed to do was to sit down and figure out how USA should be investing in its property and casualty company. There was 3 of us, and that was all we're going to do for a year. The head of department was the head of equities. He came over and headed this department. The other person was, he's now head of development at USA Real Estate Company. So he was a real estate guy. So we had a stock guy, we had a real estate guy. So what was I? I was the bond guy. What do I know about bonds? Whatever was on the CFA exam. I was the academic guy on the bond side. I was known as academic guy. People made fun of me. I know they made fun of me because anytime I called the fixed income side, friends of mine over there said that the head of fixed income put me on mute and started making fun of me. It was like, okay, I know they don't respect me, but I actually knew more about bonds than a lot of them did because they graduated in the 70s and they didn't know what duration was and all these other things. So I had some advantages over them, but I became the bond guy, and pretty scary because I'd never traded a bond in my life. I just read books about it. And so how should a property and casualty insurance company invest? And so we went out and did research, and we found the 0 pages of research that had been done on property and casualty insurance. There was none, completely empty. And so we just, my boss, I liked the way he was very, very diligent. He said, let's list all the factors that you would consider. We came up with like 18 of them, and he just broke it up. You go research that, you go research that. And we each did our own little analysis. We came up with a massive set of books that are actually still pretty valuable. Today, you could go read them. And so what we're trying to do is figure out how should an insurance company invest? And most financial services companies do something called ALM, asset liability matching, which means the assets they buy are going to be driven by the characteristics of the liability. But P&C companies don't do that. So life side, you go to a life insurance actuary and say, how do you invest? They can write a treatise on that. They can tell you exactly what they do. They'll talk about key rate durations. They'll talk about convexity, duration, credit quality. They know it all. You go talk to a bank, unless it's Silicon Valley, but most big banks know why they're buying certain assets and the risk involved. The P&C side, complete empty. There's no analysis there. So we asked the question, what are the liabilities of P&C company and what do they need? So life insurance and banks, the liabilities are interest rate sensitive. So that's pretty simple. You're going to match up the interest rate risk. The P&C side, it's frequency and severity. There aren't many assets that go up in value when there's a major hurricane or when people wreck their cars. So that was pretty tough. But one thing we do know about this is, and we're going to talk about this, is liquidity. These are liabilities that jump really fast, really quickly, where you suddenly need a lot of cash. All right, so that's kind of important. But other than that, we could not find. Some people were telling us for home builders, there's a major hurricane, home builders are going to do great. So, well, who's going to put 1% of their portfolio in home builder stocks? I mean, there's not that many of them. You know, that's great in a year you have a major hurricane, but in the other 10 years, you got too much concentration in one industry. It would not make sense to do that. Car manufacturers, right? You have a bunch of cars get wrecked. Well, you don't have many catastrophes on cars, so you're not going to go put all your money in Ford and GM. That doesn't make sense. Medical costs. They say, well, yeah, you're covering medical. Let's go invest in health insurance companies. Well, no, that's a cost to them too. They lose money when they have a lot of claims, so that's not good. Who makes money? So we really could not think of anything that was that obvious on that side, other than the liquidity equation and one other thing. So liquidity and inflation, those were the two that came up. All right. So a lot of these things didn't work. We're going to talk inflation. We're going to get into tips here, so we're going to cover that one. In fact, I think we're going to do it now because I'm looking at the time, 20 minutes. So we'll come back to this. So I want to show you the one other math question on the final that almost everybody gets right. If you don't get this right, I might just call you at 2 a.m. and ask, how could you possibly miss that question? Because it was pretty straightforward. Huh? Well, I'll look it up in ASAP.
Also,
Whatever you have in ASAP that you probably set up 4 years ago and you don't remember, it's probably a relative's phone number. I have called students at home. Actually, I called the our star basketball player for a couple years ago. You remember him? I can't remember his name. He texts me all the time now, but I called him because he didn't reply to my email, and I got his mom and is like, got him in trouble. Hey, your professor, why aren't you replying to your professor? But anyway, so not too often though. That was during COVID. I had to call people. All right, bootstrapping. What is bootstrapping? Y'all know what bootstrapping is? How many of y'all bootstrapped before? Nobody? Some of my students do from other classes. I've shown some of y'all kind of how to do this. Like paper 3 and 4 in my investment class, I said you could bootstrap, right, if you wanted to. So have y'all heard of the forward curve? Does that sound familiar? So what we want to do is we're going to say that the yield curve is a forecast future interest rates. And it's a special type of forecast. It's an indifferent forecast. It's a forecast that says, what is that future rate so that you're indifferent between buying this bond versus buying that bond. It's really powerful stuff. You should learn how to do this. It is, first of all, you may be in a job where you need an interest rate forecast, and this is the cheapest way to do one. And it's probably the most effective because you got a forecast from people who have skin in the game. They're the best forecasters. I'll talk about that in my risk management class. If you have someone actually betting on something, they're going to give you a better forecast. It's also, it comes up. So I've told students this story many, many times where I just sit in my office and pick up the phone and it's the CEO of UTSA. He's like, Ron, I'm in the room with 30 finance people and none of them know how to bootstrap the yield curve. Can you show them how to do that? Yeah, I knew how to do it because we did it on the CFA exam. Now, why didn't anybody in that room know how to do it? Because they're all accounting majors. So they didn't know how to do it. Of course, if I didn't know how to do it, I would have lied and told them, yeah, I know how to do that. Yeah, but I did know how to do it. Bootstrapping, it's pretty powerful. In fact, at UTSA, we were spending thousands of dollars on a forecast, and I discovered the forecast, all they were doing was bootstrapping yield curve. It's like, we can do that. We don't need to pay someone else thousands of dollars to do something we can do. So it's really powerful. It's a good forecast. It's probably a very, very accurate forecast relative to others. I've actually even graphed, and something you can do is go back and get historical forecasts of interest rates and graph it against the actual interest rates and see how good of a job they do. It's not perfect, obviously. A lot of them didn't get 2022's shoot up in rates, but it's better than what economists come up with. So essentially what they're saying is, let's take two bonds. Let's take 10-year treasury. Let's take the 5-year. So we won't do the math tonight. I don't think. We'll see. We might get, I don't know. So let's say you have some choices here. You can buy the 10-year today, or you can buy 5-year bond today, and then buy another 5-year bond in 5 years. Now, it's really bad that I use 5 and 10 because we got too many 5s. But I'll start with this one. We'll do some other ones so you can see. Now, which of these should you do? It all depends on what one number that we don't have. What's your big unknown here? You know what today's 10-year bond is. You know what today's 5-year bonds. What's your only unknown? The 5-year bond yield in 5 years. But we can figure out what rate that rate would be such that these two options have the exact same return. Okay, and that's going to be our difference. So if we buy the 10-year Let's use some real life numbers. It's kind of boring today because the yield curve is inverted. That's okay. It was more interesting a few years ago. So pretty unusual looking curve, right? It's supposed to be upward sloping, and right now it's downward sloping because of the Fed. So right now, the 5-year, see, this is boring. I'll tell you what, I'm going to change my opinion. So let's change it just for today. Yeah, that's going to be tough, but okay, I'm going to try it. So we could buy a 1-year bond today and then buy a 9-year bond in 1 year. All right. So the 10-year bond today, if we do that, we're going to get a yield 352. And that rate's been all over the place. This is why I texted my friend at Victory Capital. He's a bond manager, with the question, do bonds rally or sell off this year? And the answer was yes. Yes, they do, because we've just been, have y'all seen what rates have done this year? And it's been massive. I don't mean like they've had a massive sell-off, a massive rally, another sell-off, another rally. So 352 is kind of in the midpoint, because remember they got up over 4% there. All right, what about the 1-year bond? Well, that's interesting. The 1-year bond, you might say, you know, why don't I just do the 1-year bond? Because the rates are so much higher. So 1-year bond, my word, you can get 476. So what is the bond market telling you interest rates are going to be a year from now? Much, much lower, right? So the 9-year is probably around 352. Unfortunately, I can't get you the 9-year rate, but it's going to be somewhere between. It's going to be pretty close to the 352, right? Because the 7-year is 356, the 10-year is 352. So the 9-year is probably right at that level. Someone might say, well, let's just keep buying 1-years. But the bond market's telling you they really think the 1-year bonds can be much, much, much lower a year from now. It's kind of interesting, right? They're expecting a recession, or they're really expecting the Fed to be cutting rates in about 6 months. All right, so let's say in 10 years, what will you have? And y'all know this formula, right? Someone tell me the formula. What's $1 going to be worth in 10 years? Didn't y'all do this on the securitization problem? The cat bonds, y'all remember? Someone knows it, you're just too shy. 1 plus that, raised to the 10, pretty simple, right? Y'all know that. What will this bond be worth in a year? Pretty simple. And what are we going to do with this bond? We're going to reinvest it for 9 years. Okay. What rate does that 9-year bond need to be so that we end up with exactly 141? So 1 year, we're going to get $1.05. We're going to buy a 9-year bond. What yield does that need to be? So we'll end up in the 9 years later with 141. So here's the formula. 1 plus the 10-year. Raised to the 10. Divided by 1 plus 1 year. It's the 1. And how many years is all that going to be for? Raise that to the 1 divided by 10 minus 1 minus 1. You see what I'm doing? Look, have you have never done this in any class ever? Familiar? So look at that. So 1 plus the 10-year to the 10th, that's the 141. I only have $1.05 to invest. So what is that to the 1/9? That fraction, what is that to the 1/9? So let's just try it and see what happens. So we're going to take this divided by that, raised to the 1 divided by, and the reason why am I doing 10 minus 1? Because when we do the 10 and the 5, if I raise it to the 5, am I raising it to the 5 because we're using the 5-year treasury? Or am I raising it to the 5 because I'm doing 10 minus 5? So I want you to get used to it's 10 minus, it's the longer bond minus the shorter bond, all right? So you need to make 338. So let's try it. Let's just see if that works. We take $1.05 after 1 year and we invest it at 338 for 9 years. What do I end up with? $1.41. All right. What if you believe 9-year yield be 4.2% 1 year? What would you do? Would you buy the 10-year today? Or would you buy the 1 year today and buy a 9-year a year from now? Some of y'all know, but you're scared to death. You're missing it and you don't want to say it. I think Cassandra was saying it right. Yeah, if you buy the 1, you can just see that times plus 0.42 raised to the 9th, you end up with 151. And then obviously, what if you blame the 9 years is going to be 2.4%. By that 10-year, you got it locked in. Why? Because you're going to have much less money here. But you can even get more aggressive than that. What else could you do with this first one? It's true, you could just buy a year and then reinvest in a year. But what else could you do? You could short the 10-year today and buy 1 year. What would happen there? You short the 10-year, you buy the 1 year. A year from now, yields are much higher. What's that 10-year going to be worth a year from now? You sell it for $1,000. A year from now, rates are higher. What's a 9-year treasury going to be if rates have risen? Would have fallen in price, well below 1,000. So what do? You buy it back at 900, 800 and something, and then you're going to reinvest that 1 year at 4 something. So you can actually short the 10-year. If you believe this, you can actually execute this today and lock in that much higher gain. So you kind of get the double benefit. You get to reinvest at a higher rate at 4.2, plus you get to buy back this bond that you shorted. Y'all know what shorting the security means? You sell something you don't own. That's really easy to do with treasuries. I did that. One guy here in town worth a lot of money, so we shorted some treasuries and he made some money off of that. It was pretty easy to do. He just went to his broker and said, I want to short. Now we also tried shorting tips, and that wasn't so easy. It's not as easy to find tips, but treasuries was pretty straightforward. The other scenario, if you think rates are going to be 2.4, then you could short the 1 year, buy the 10-year. In this case, a year from now, that 1 year is going to be worth $1,000 because it's going to mature at 1,000. But the 10-year, because rates are falling, it's going to be worth $1,300, $1,200. So even then, you're going to have a big gain. So yeah, you can actually execute this. Now, what are we going to do here? So we're going to get a little fancier. What if we add tips to this. So what is a tip? Inflation indexed bond. So have y'all heard of tips? They've been around since about 2003. So we actually have a security where we can bet on inflation. So an insurance company could actually do this. And I'm going to show you one transaction which I think would work, but I haven't found an insurance company to do it. I wish I were back at USAA because I'd actually try this transaction. So I'll show you what I think is a pretty fancy one. You might bring this into an interview question. They might find that someone needs to go out and test it. It would have been a great paper 2 topic, but it's too late. We're just not getting to it. All right. So combining all these together, what we can do, we can actually get a forecast of yields. We can also get a forecast of inflation, which means we can also get a forecast of real yields. We can get a forecast of nominal yields. Why is this important? Well, your first job, they may want you to give them a forecast of inflation. What better forecast can you get than the bond market that has skin in the game? Far better than anything you can get from some economist that doesn't lose anything when they have a bad forecast, right? So it's really powerful stuff. It doesn't fit perfectly in this class, but because we're so worried about inflation, here's a way to hedge inflation. So I do it in this class. It's the only class I cover this in. And if you don't have it in any other class, you need to have this before you graduate. So at least force you to get it. But it is very straightforward on the exam. The questions, I'll show you one of the exam questions. So, all right, we'll stop there. So we're doing some bootstrapping, pretty cool stuff. So what I want to do is what we did last class, but add the tips to it because it provides a lot of extra opportunities. So this is April 25th, which is yesterday. You see the 10-year, it's pretty incredible. The 10-year is back below 3.5%. Yeah, it's been a crazy year for bonds. I don't know what they did today, but yeah, they really rallied yesterday. They're back up a little bit today, but we're still below 3.5%. The 20-year is at 377. So this part of the yield curve is still upward sloping. The 5-year is at 343. So the 5-year is higher than the 10, but they're essentially equal. So there's a little bit of upward slope in the 20. Obviously, the 1 and 2 year are like 4 something. So the Fed's still raising rates. So the market's still saying they think the Fed's going to cut rates, but at least we have some room. So right now, if we did bootstrapping between the 5 and the 10, it's going to be really boring because they're so close to each other. Not going to get much. So we're not going to do that. We'll do the 5 versus the 20. If you look at tips, there's some spread there too. So these are the inflation index. So let's put some rates in there. Let's do the 5-year and the 20-year, and let's do nominals and tips. So the 5-year is 343, the 20-year is 377 tips, 5-year is 117, 20-year 130. So I'll give you these 4 numbers, and there's a few things you want to do. You want to do the forward nominal, you want to do the forward real, and you want to do what we call break-even inflation. Break-even inflation, if I were in finance today, I would have that on my machine in Excel, linked to Bloomberg and updating every single day because it's a really, really powerful number. In fact, I went to one inflation conference. It was completely over my head, but there were a couple of sessions I understood, one by a guy named Brian, I forget his last name, but he worked for the Fed. Knew Greenspan, knew Bernanke personally. So at dinner, we're getting all these inside information. And he said for Bernanke, this break-even inflation was his most important number for watching inflation. My guess is Yellen and Powell probably as well, because it tells you what the bond market thinks inflation is going to be in the next few years. That's an extremely important number for the Fed to know, because the bond market, you probably heard the term bond vigilantes. Have you ever heard that before? Bond vigilantes. Who was it? There's some guy on the left. Cardell, I can't remember. He's married to someone on the right. But anyway, he said, when I die, I want to come back as a bond vigilante. Because what he said is, when bond investors loan to governments or to corporations, they take all this control and they essentially start dictating what they can do and not do. And so they have a lot of power. And the bond market have a lot of power because if they don't like what's going on, they just don't lend money, which means everything shuts down. But they have expectations, on those expectations actually cause things that happen today. And so these bond markets can tell us what the bond market is thinking into the future. Now, what forward can we get? Well, we can figure out the 15-year treasury yield expected in 5 years. And why is that? Because we know the 5-year yield today, we know the 20-year, the only difference is the year 6 through 20. So we can forecast the 15-year nominal. We can forecast the 15-year real yield. That's what the tip is giving you. And we can forecast inflation expected in 5 years for the next 15 years. That's known as the break-even inflation. So essentially, what this break-even inflation is telling you is, what would inflation have to be from year 6 through 20 such that we're indifferent between the nominal and the tips? We have no preference between them. Now, when I went to the inflation conference, he brought in something called an inflation premium. We're going to completely ignore that. But his argument was the nominals are getting a little extra return to compensate them for inflation risk, which the tip investors don't need because they're already getting protected from inflation. And he went all over the place. He said that might be 25 bips, it might be 50 bips. I called him after the conference. He wanted nothing to do with me, but he still answered my questions. I could tell from his tone of voice, it's like, who is this idiot calling me out of the blue? But I did, and he did answer the question. He wasn't forthcoming with papers or anything else, but at least I got an idea had he changed his opinion on that. But we're going to ignore that. I don't think the Fed really is worried about that particular risk premium. They're more interested in the direction. How has this changed over time? So let's take each one of these. So this one, let me show you the formulas if it looks familiar. So you're going to take the longer yield first. So 1 plus the 20-year yield raised to the what? To the 20th. You're going to divide that by 1 plus the shorter rate. So that's the 5-year yield raised to the 5th. All right. So you're going to take all of that and raise it to the 1 divided by, and remember here, don't always write it out, 20 minus 5. All right. Because especially if I'm doing a 10 and a 5, people get confused. So you take it's the longer time period minus the shorter time period. So last class I made it confusing because I was using a 10-year and a 5-year. So what am I raising it to? So you're raising it to the difference in those two, minus 1. All right. Well, guess what it is for the forward real? Exact same thing. We don't have to change anything. And then what is the break even? It's the difference. So that makes it really simple. So it's really just one formula and you take a difference in those two formulas, those two calculations. So we'll do 1 plus the 20-year raised to the 20th divided by 1 plus the 5-year raised to the 5th power. All of that raised 1 divided by 20 minus 5 minus 1. Now, the 5-year is lower than the 20th. the 20-year, you get that the entire 20 years. So what we're saying is you're going to make 343 for 5 years. What weight would you have to make from year 6 through 20? So you end up with that 377. Well, obviously it has to be higher than 377 because you got to make up for the fact you only made 343 for 5 years. So we know we better get a number that's like 395. I have no idea. I can't do it in my head, but 385. You know it's going to be higher. So there's 388. So what does that mean? If I make 1 plus 343 for 5 years, and I take that and invest it at 1 plus 388 for 15 years, I should get the same thing as 1 plus the 20-year raised to the 20th. Should be exactly the same, and they are, right? So what are we going to do? We're going to take $1,000 invested at 343 for 5 years, and then take that maturity value and invest it at 388 for 15 years, and we should get exactly 377 over that entire period. The original 20-year. All right, questions on that? Does that make sense? Now, what does the market think the real yield is going to be? So here, it's the same thing. You can get a real yield of 117 for 5 years, a real yield of 130 for 20 years. Obviously, they're expecting the real yield to rise. So 1 plus the longer term raised to the 20th divided by 1 plus the shorter term raised to the 5th raised to, again, 1 divided by 20 minus 5 minus 1. Does that look reasonable? 134. I think the reason I mess up on the 388 is I'm forgetting because I'm so used to doing the 10 and the 5, but here we're doing 20 and 5. So it doesn't have to be as big as 2 have a difference. So that 134 is probably accurate because you do 117 for 5 years, but you do 134 for 15 years, you're going to make up a lot of that 117 deficit. But we can test it. You invest at 117 for 5 years, and then you take that maturity value, multiply it by 1 plus 134 for 15 years. You get that. Compare that to 1 plus 130 and the 20th, and it's the exact same answer. All right. So what is our break-even inflation? 388 minus 134 is 254. So the market thinks, now what's the Fed's target? 2%. So the market doesn't think the Fed's going to get there. They think 5 years from now, we're going to average 2.5 inflation, 2.54% inflation for the next 15 years. So they're not too confident the Fed's going to get down to that 2%. I'm not either. And I would guess Jerome Powell's not either, but he's not going to say it. I think he'd be ecstatic if they could get down to 3. 3 would be, I was listening to a podcast. Oh, who was it? It was the Damadoran, as how I say his name, but it's the Mamdoran. He says it differently. They were talking about this, and he was talking about something I remember during my career. Is like you realize in the 90s we were talking about how we really need to get to a 5% inflation. That's a really good number. We got to get down from these 8 and 9% numbers. So we were thinking 5. If we can get to 5, that's all we need. We're perfectly happy. Now we're like, no, 5 is way too high. 2 is what we need. I don't know why 2 is the magical number, but for some reason, but if he can get down to 3 or 2.5 would be pretty good. I think he'd be more than happy to stick there. We need high inflation anyway because our government has a 30-something trillion dollar deficit, and the easiest way to get rid of a deficit is to monetize it, which just means high inflation. Robert Arnott, who is one of my favorite writers, he thinks they should actually go to a 5% inflation to get rid of some of this government debt. But who knows? So there's debates. But the bond market's telling you, even though inflation's really high right now, they're expecting it to come down quite a bit, but not all the way down to the 2. You can just take the 5-year nominal and you get 226. So even over the next 5 years, it's not that high, but we've had fairly low inflation price into the bond market for quite some time. Now, what does all this mean? So, if you think the 15-year treasury is going to be much higher than 388, and buy the 5-year, short the 20-year, and then in 5 years, that 20-year, if rates are higher, it's going to be underwater. You'll be able to buy it back, have a big profit. If you think the 15-year is going to be much lower than 388, then buy the 20-year, short the 5-year. You'll come out way ahead. You can do the exact same thing with inflation. If you think inflation is going to be much higher than that, then short the you got so many combinations, but you could definitely short the 5-year treasury, go long. Well, I don't know if boy, you have so many combinations. So short the 20-year nominal, buy the 20-year tips, buy the 5-year nominal, short the 5-year tips. You'd have to set it up. I'm not going to even get into that math, but you essentially, if you disagree with this 254, you can set up a trade so that you can lock in your belief whether it's higher or lower. Now, a transaction I was really interested in is an inflation-linked corporate bond, because we're going to talk here that insurance companies, they do buy treasuries, but they don't, maybe 10-20% of their portfolio. The bulk of their portfolio are corporates. But there aren't any inflation-linked corporates, at least not in the United States. So how could you do that? So what if you buy a corporate bond? That's pretty easy to do. You short a nominal treasury and you buy the tips. What would you end up with if you did that? That's a pretty easy transaction to do. It's really easy to short treasuries. It's hard to short tips, but it's really easy to short treasuries. What would you end up with? Well, this bond is going to be the risk-free rate plus a spread. This one's going to be the risk-free rate. And this one's going to be the real rate plus inflation. We're going to short this. So what would you end up with? Real rate plus inflation plus a spread. I don't think I've spelled inflation correct once. And what is that? An inflation linked corporate. I think it could work. Unfortunately, I thought of this idea like 3 days after I retired, so I couldn't test it, but I would have loved to have tested this at USA. I think it would have been pretty cool, but I don't know if anyone's doing this. Someone in this room needs to go try this at your job and call me and let me know if it worked or not. That'd be pretty cool, right? And a lot of people would love to have an inflation-linked corporate. Now you might say, well, they still got the spread risk, but they had the spread risk before. That's always there. That doesn't change any. But at least now you have an inflation-linked corporate, and it's got the advantage that you're shorting the nominals. I have shorted tips before. There's just aren't that many of them, and when you're going to short a security, it has to be in the inventory of your broker. Brokers tend to have a lot of treasuries, so those are pretty easy to short. And a lot of people hold treasuries to maturity. So you borrow someone else's treasury that they're going to hold to maturity anyway. You sell it. It's not that difficult a transaction. On the tips, we had some problem with tips where we get called and said, hey, they want their tips back. Like, yeah, well, we don't want to give them back. It's like, you don't have any choice. You got to unwind that transaction. They couldn't find other tips. So this transaction has the advantage that you're shorting the most liquid security, which is the easiest thing to short in this entire thing. So, all right. So that's the 15-year nominal expected in 5 years. This is the 15-year real rate expected in 5 years. And this is inflation expected years 6 through 20 on average. Now, I don't know with average how it's linked and all that, you know, you have to do, I kind of think about that. We don't generally link inflation, so it's just the straight arithmetic average over 6 years. I don't know. You'd have to do some analysis. The way tips work is they don't pay you inflation. What they do is they add inflation to your principal every year. So if your principal is $1,000, inflation is 3%, the government's going to pay you back 1,030. Your principal amount just rises. So there probably is some compounding then, because the next year they're going to add that inflation to the 1,030. So it probably is the geometric average through those years. Now, something that's really cool, I should do it and show it to y'all next class, but I don't know if I'll have time because I got so much grading to do this weekend. But if you think about the 10 and the 5 year, you get that forward 5 year, you could go back, get this stuff historically, bring in the 10, bring in the 5, get that forward rate, and then right next to that graph, the actual 5 year yield 5 years later. And I've done that before. It's really interesting. So you're just asking the question, how good of a job did they do of forecasting that yield? And it's not too good, but it's probably better than any other forecast out there, because no one's really good at predicting interest rates out that many years. So at least gives you, you know, someone says, hey, we need a forecast, and yeah, I'm going to use the forward curve, and they ask, well, how good is that? Then you can actually go out and test it. Now, if you go on Bloomberg, Bloomberg does have the forward curve, but their numbers are always slightly different than mine. And I think the reason might be, let me show you what I might do differently, and you tell me what I'm doing. I'm going to raise this to the 40th, raise this to the 10th, and raise this to the 40 minus 10. So what did I just do? But why would I do that? Coupons are paid twice a year. Does it change it? Didn't seem to change it much there, but you know, probably changed it a little bit. It's going to change it some. I don't know how much. You can compare the two. I hope it changes it some. I don't see how it would not, but no, it should have changed it. I don't know why. Oh, I know why. Okay, just a second. I should erase that. Just a second. I made one mistake. I'm surprised it came out exactly like that. Got too many things going on here. All right, there's the original one. All right. Probably what I should have done is divide that by 2. Divide that by 2. And then raise this. Yeah, I got a parenthesis in the wrong place somewhere. What? Well, you get the point. I have to think about this. I should get this right. This should be a lot simpler. So this would be the 20-year divided by 2 over 40 half-year periods. So it's twice a year. So that should be fine. This should be the 5-year rate divided in half over the next 10 periods. And then raise that to the, we can probably go back to the 1/5. I'm not sure. That's probably correct there. I don't know. I'd have to experiment with Bloomberg to see exactly how they're getting it, but there is a difference, and that's a pretty big difference there, about 4 basis points, which is real similar. So I do think Bloomberg is adjusting for the fact that you pay coupons twice a year, and that gives you a little bit different answer. But so when you get into Bloomberg and look at the forward curve, if you use exactly my formula, it will probably be off 3 or 4 basis points. And I think that may be the reason. Now, if Bloomberg is lower, then that's not the reason. They would have to be higher. So that compounding should increase the yield some. But what kind of impact it has on this bottom number, I don't know. I'd have to redo this one the same way. So divide by 2 to the 40th. Divide by 2 to the 10th. 135, that minus that gives you quite a bit higher number, doesn't it? 3 basis points higher. So yeah, it's significant. So I can't tell you officially what people do. It would be really cool if that exactly matched out to several decimal places to Bloomberg, because then I'll know for sure it is exact. So one of these days I'll go and test that. But very, very powerful stuff. Boy, it gives you insights that are extremely valuable. I remember when this number shot above 3%, and I was like, I'm gonna go buy a bunch of tips, but unfortunately I was in a job I couldn't do that. I was like, you're telling me I've got locked in. I'm talking about this number here. I'm sorry, this number here. The real yield was 3%. You're telling me I got locked in 3% plus inflation over the next 20 years? That sounds like a really good investment. Right now you're getting 134. What was this number a couple years ago? It was like negative 0.7. It was a negative 70 basis points. So we actually had a negative real yield. I wouldn't buy. Why would you buy a bond that's going to guarantee that you underperform inflation? That's essentially what you had. So when this right here, the 134, when it was above 3, I was like, yeah, I should be buying some tips. That would be a really good investment. Right now at 134. So what should the real yield be? Some people say, there's a few theories out there. What did they say in your money and banking? Yeah, remember? Because I'm not an economist, so I'm outside my league here. When did y'all take money in banking? Was it recent or a few years ago? So one theory is it should approximate real GDP. So if our economy is growing at 3%, the real rate should be at 3. Some people say it should approximate real GDP minus a risk premium. And that argument makes more sense to me, because if you can buy treasuries, you can get the economy, then what is everybody else going to get? It's like we got to share this economy with everybody else, and the people taking risks should get the real GDP plus a risk premium. So if I'm taking the risk-free item, I should get real GDP minus a risk premium, so we have something to share with everybody else that's taking risk in the economy. So that's my thought on it. I don't know if you don't remember. Do you still have your money in banking textbooks? You can look that up and see. Y'all sold that back. That was probably the most important class you took in undergraduate, because of what's going on right now. But anyway, so those are the theories. There's probably other theories out there, but I could probably just Google it and we'll see a Friedman article come in. What should the real rate be? 1 point times inflation. The Taylor rule. Taylor comes up there. So there's stuff out there. The wonderful thing about tips is the tip yield is the real yield. So that 130, that is the real rate of interest. So if you ask, someone wants to say, hey, what was the real rate of interest in the 70s? We don't know, because there were no tips. So in the 70s, the real rate was theoretical. And I can't spell theoretical. Oh, that's not right. That looks wrong. It was theoretical. Why? Because the real rate is the nominal, not minus inflation. It's the nominal minus expected inflation. Where do you go back in the 70s to find expected inflation? We don't know. But today with tips, we do know because it's in that yield, that 130. So the real rate of interest is the tip yield in the 70s. Now, I've gone back to the 70s and taken a nominal and subtracted like the prior year's inflation, just assuming whatever inflation was the last 12 months, that's what we're expecting. But you get some really wild numbers, especially in the early 80s when everybody's expecting inflation in the fall. You got some really, really wild numbers. So you can't really do that. So we've had tips, I think, since 2003. So that's pretty cool that we now know what the real rate of interest is. And so all these theories can be tested. You probably should know the Taylor rule. Some people thought, let's see, an interest rate, an inflation rate, GDP rate, all based on equilibrium rate. So interest rates, inflation, GDP. The formula suggests the difference between nominal interest rate and the real rate is inflation. That's pretty straightforward. Real rate accounts for inflation while nominal rate does not. So the Taylor rule is out there. There's been a lot of debate here recently on the Taylor rule. It's a much simpler rule than probably some of the other economic rules out there. But yeah, go find your money and banking textbook or steal one from a friend. You probably have friends that are in that class, or email them. What's the textbook say about what? So that's the question. What should the real rate of interest be? If it's below that, what should the government do? If it's above that, what should it? We're not talking about inflation. We know, inflation should be whatever the Fed says it should be. It used to be 5, now they're saying 2. We're talking about the real rate of interest. Theoretically, what should that number be? And if it's too low, does that mean the money supply is too large or too small? If it's too high, does that mean the money supply is too large or too small? Should the Fed do something to come back on the money supply? Why should you know this? Because you're finance majors, and that's a big part of your job, is to understand what the Fed's going to do, what interest rates are going to do. So it's pretty important. All right, let's do another one. Get some more practice here. We don't have a lot of choices though, do we? So we're running out of choices. I wish we had some shorter rates. I can't give you shorter rates because inflation index, they start at 5 years. So I can't do like the 2 versus the 5, which would be pretty interesting. I can do it on nominals. I can tell you what the bond market thinks the 3-year rate's going to be in 2 years, but I can't do inflation, and we need inflation. So let's go back and do what we did before. Let's do the 5-year, which this one's actually quite popular. And in fact, when you're looking at what the Fed's looking at, it's usually the 5 versus the 10. That's the most common one. So you got the nominal, you got the real. I tell you, y'all calculate it, and then if you get it right, I'll pay you $10,000 each, unless I change my mind later. All right, so let's put the numbers in there. 3.343, 340. This one's going to be really boring. Oh man, it's gonna be really boring. Maybe the real rate will save us. 1.17. Nope. 1.15. But do it anyway. Get some practice. I'll give you. You should be able to do this in 3 or 4 minutes. You just have the formula top of your head. It's a pretty easy formula. Some of y'all don't even moving. Brandon, at least pretend like you're typing in your Excel. You can't remember the formula. Y'all want me to bring the formula over? In the exam, you don't get this, right? So you might as well learn it now. And you really should practice it because you get one parentheses off, it's going to be, the whole thing's going to be wrong. You might want to do something where you write the numerator down, then write the denominator down, then divide, and then do it. If you do it in steps, it's really tough on a calculator. You're not going to have Excel on the exam, so You know, don't practice this at home on Excel and then come in and try to do it on a calculator. And does your calculator have parentheses? Well, you have to change the numbers here, right? This is the old problem, so you can't do this exactly. You know, a calculator, you can maybe use your phone. You know, you can't do that on an exam, but you can do it here. Just turn it sideways. You definitely want to practice this for the exam. If you walk up to me before the exam and say, "Where's my exponent key?" You're in trouble. I mean, I'll try to help you, but it's not the time to be figuring calculators out. Anybody have it yet? No? You got it, Enrique? If I had a guess, I'd probably say that'd be my guess, but we'll see. Is that close?
The first one, but the second one.
A little bit off.
I got the second one, I got 1.19.
19, really. It should be lower.
Should be lower.
Yeah, you can't do 117 for 5 years. And then doing something higher than 115 for 5 years and end up with 115. So yeah, double check there. Maybe it's 113, but it's going to be something less than 115. But the first one sounds right. So yeah. I don't count out for math errors if you write out the entire problem. So write it all out on the exam. Although, like on that one, you know, if you can kind of tell it's wrong, you should at least write me a note, say, hey, it should be lower than this. Anybody else have it? Gilbert, you got it? No? All right, well, let's try it. So here, we take 1 plus 3.4 raised to the 10th divided by 1 plus 3.43 raised to the 5th. All of that raised to 1 divided by 10 minus 5 minus 1. 337. That sounds about right. Here, I'm going to take 1 plus 115. Yeah, I wonder, Enrique, if you might have switched to 117 and a 115.
No, sir.
No?
No, sir.
All right, well, let's see. Maybe you're right.
Actually, not yet. Yeah, I didn't. I don't think I did.
113 is what you got.
Yes.
Looks like it's almost a very round number, but anybody else get either one of those? Nicholas?
Retrying it.
No one else?
Syntax error.
Syntax error on your calculator?
Yeah.
Huh. You know, try pieces of it, because you could essentially, so here we have 1 plus the 10 to 10. You could do that first, write it down.
Yeah, I got 113.
13. All right, good. And the same thing there. So, you know, if you have to break it up, it's tough to get that entire formula. It's easy to do it in Excel, but even then, you got to really watch the parentheses. All right. And so, what is the break even? 2.24. It's interesting that it's such a low number, but there must be some confidence in the Fed that they think that's 224. Now on the exam, I'm probably going to cheat and not use the current numbers because they're just too close. So, you know, if the 5 year equals the 10 year, then there's nothing to do. It's, you know, if the 5 years 340 and a 10 years 340, then it's just going to be 340. So there's nothing to calculate. So I might say in March of 2019, these are the rates. What was implied back then. You could certainly do that kind of math. Let me just show you, and I mean, it is pretty cool how to do this. Let me walk you through this process, because this might be something you could do in your very first job and they'd be really amazed. So you just type H15, and it used to be the first thing that came up, but unfortunately, this thing is now coming up. Sylvania H15. But the second thing that comes up now is the Federal Reserve, and you just click on historical data, and click on historical data again, and click on historical data again. It will bring in eventually somewhere download file. I don't know how many times you have to click on it. It'll bring in the numbers. So what I like to do, it's just really cool, is do the 5-year and do the 10-year. That is the 20-year. They stopped doing the 30-year because it keeps disappearing. No, there is a 30-year. So here's our 5-year treasury. Here's our 10-year treasury. The only irritating thing about the Fed is they leave holidays in here. And it's really quite irritating that they do that. So you do have to do a data sort and sort out the holidays. But if you want to know all the holidays, the last since 1962, there they are. A bunch of them. So the exact same formula we just did. Now you notice this is not in percents. So if you want to make it a little easier, you can certainly convert it to a percent. Makes the math a little easier. You don't have to add in the divide by 100. And so you just do equal 1 plus the 10-year, raise the 10, divided by 1 plus the 5-year, raise to the 5th. 1 divided by 10 minus 5 minus 1. And I did something wrong, so where's my parentheses problem? Oh, right there. Okay. Does that look right? It's got to be higher than 406, right? If 5's lower, the forward rate has to be higher than the 10-year. If 5's higher, the forward has to be lower than the 10-year. So we do that. And then we can go out 5 years from now, which would be January 67, and get the 5-year January 67. Way out there. Ah, it worked. Sorry, it's going to take a second. Hello. And then you can graph those too, and it's a really interesting graph. It's probably going to be too much data for here, but so this is what they're forecasting the rate to be. This is what it actually was 5 years later. Now, I may not have this exactly right, and I've thought about this. I'm doing the yield exactly 5 years from now, but you know, this is probably accurate here, but when you do inflation, you can't just go out and get the inflation rate 5 years from now. You have to go out and get the average rate over those 5 years. So it's a little bit different type of analysis. So if you do this inflation is a little tougher because you don't get daily inflation, you get monthly inflation. So that too is an issue, but you can do this exact same thing with that break-even inflation. And you can see they really miss it sometimes, right? I'll put some years on here. So the 80s, they expected rates to rise, but they rose a lot faster. Then they expected rates to rise, but instead they fell. So you can see they, just like any other forecaster, they can't get the turn. They tend to extrapolate. Oh, rates are rising, so they're going to continue rising. So here they expect them to rise a lot. Instead, they came down. Why? Because Paul Volcker came in and, you know, he raised rates and then fixed it, and rates came back down. Inflation was starting to come down, and then it got easy for them. They predicted rates would fall, and rates just kept falling. Now, in my my risk management class, we talked about 94, 95. You can see that. You can see they were off there, but they missed it, kind of trailing. But they definitely missed this last huge rise. They weren't seeing that. They thought rates were going to stay pretty stable. But you can do this. You can do it with the real rate. You can do it with the break-even inflation, and you can. Here I did it with nominals. And if you want to get more current, you could do like the last few years. See how good of a job they've been doing recently, and then you can really see the lines a lot better. I mean, that looks pretty good, doesn't it? Oh, I graphed the wrong thing. Sorry, it looks good because I graphed the wrong thing. So this is what rates actually came out to be. So they were predicting to be 2.5%. They actually came in at 4. They were predicting here to be 3.36. Is over 3.5. Here they're expecting 3.39. It was actually almost 4.5. But here they're expecting rates to fall, and then they started expecting rate. You know, you get a good sense of what the bond market is thinking. All right. Anyway, powerful stuff. So that brings us to the question: how do P&C companies actually invest? All right. So any questions on bootstrapping? You know, you're going to get that question. Just plug it into the formula and do it. All right, so I think we spent 9 months on this project on how insurance companies should invest, and there was no analysis. So this is what we came up with for the industry and how we differed. So they buy a lot of bonds, but there's a big difference between life insurance and property and casualty side. They buy corporate bonds on both the life and P&C side, but the P&C side does buy some treasuries. Life insurance side buys 0 treasuries. You cannot make money in life insurance if you buy treasuries. There's a big concern. They had something called the Volcker rule. And the Volcker rule was, don't let banks buy corporates and risky assets because they're already too risky. And then that law got expanded, not just to banks, but to all financial services companies. And there are a lot of life insurance companies going, yeah, our entire model break. We can't operate. We can't buy corporates. P&C buys a significant amount of corporates. They could have a 5-10% in treasuries. And why do you do treasuries? Not because the yield's any good, but because they're extremely liquid. And remember, this is an entity that has catastrophes that could be billions of dollars. They need to be able to get their hands on cash pretty fast. Treasuries are very, very liquid. So life insurance companies don't buy any treasuries at all. P&C companies might buy 5-10% in treasuries. Life insurance companies buy a huge amount of corporates. P&C companies, they may have 30-40% in corporates. So in life insurance, like the life insurance company where I work, they were essentially 98% corporates, 98% corporates, almost all corporates. They used to buy mortgage-backed securities, and I fixed that. That was one of my big claims to fame is they went from 20 billion or 10 billion mortgage backs to 0. And so they bought a lot of corporates. But they do buy them for the yield. And we talked about this in my risk management class. So you do get paid pretty good compensation buying corporates. You will get paid much more than the expected losses on those corporates for defaults. So it makes sense. The big exception for P&C companies is what they do with municipal bonds. The P&C industry is one of the largest investors in municipal bonds. I don't think they're as large as the mutual fund industry, although it's probably pretty close. So there are a lot of municipal bond funds, people, individual retail investors that want municipal bonds, but P&C industry is a huge investor in municipal bonds. Life insurers do not buy municipal bonds. So you know there's something going on with the tax code because municipal bonds are tax-free, corporates are not. And it's just the way the tax code is written. If you want to know the most complicated part of the tax code is the insurance part of it. There's an entire section of the tax code called non-life insurance companies. So they have a distinction between life insurance companies and non-life insurance. And so the code is very, very complicated. So you buy municipal bonds. Now, USAA did not buy a lot of municipal bonds, but that's because it's a reciprocal. They were already tax-free. So they didn't need municipal bonds. They bought them in the taxable entity, but in the non-taxable, they didn't do municipal bonds at all. But I've seen Allstate with 40–50% of their portfolios in municipal bonds. Now, what's the concern there? So on an after-tax basis, they obviously give you a really good return versus corporates, and that's the reason they do it. The tax code does that. But what happens if there's a massive, massive hurricane that hits this industry and all these P&C companies are selling municipal bonds at the same time? That could be a disaster. Because who's going to buy them? Right? There's not enough buyers on the other side. So that's one of my fears on this industry. Now, their thought is, well, we have the treasuries to handle that. So we'll sell the treasuries. If we have to sell something else, we'll sell the corporates. But yeah, when you have 40–50% of your bonds in municipal bonds, you're taking, I think it's a pretty big risk. So that's what I was showing you. All of this is in that annual statement. You can go and see how many municipals they have and see what. So that's what I did, and that's why I was shocked. Allstate had the largest by far. I don't know if they do today, but they did back then. Now, when I was at USAA, I worked closely with Donna. She ran the property and casualty bond portfolio, and we were constantly back and forth. I was checking with the tax department, what is our marginal rate? I would give her a number, and she would figure out if municipals made sense in the taxable entity or not. And so she was always competing between corporates and municipals. It all depends on the tax rate, but yeah, it was pretty useful to do. But something happened in the last few years. This is USAA's tax exempt bond fund, and it has a yield of 309. The 10-year treasury is at 350. For most of my career, municipals had a higher yield than treasuries, or lower, much lower, like a 70% yield of treasuries. They've now finally fallen below treasuries, but for the longest time, last few years, municipal bonds had a higher yield than treasuries. And now look at that 309. I mean, the municipal bond yields are unusually high right now. I mean, that's my bottom line. I hate that thing. Municipal bond yields are unusually high right now. So the P&C industry has probably even a bigger incentive to buy municipal bonds. It's not as big now as it was last year, but it's kind of amazing how much you're getting paid. Now, I know Trump changed the tax law, reducing corporate rates. That harms municipal bonds because the benefit's not as big, but it's not enough to explain what's going on here. So it's kind of hard for me to even understand these yields. They're just way too high. So corporate bonds are very, very illiquid, but they pay great yields. Municipal bonds are terribly illiquid, but they pay very good after-tax yields. So because of that, the P&C industry buys a significant amount in treasuries. They don't buy much in mortgage-backed securities, but mortgage-backed securities are very, very liquid. So you could probably justify a 5% allocation to mortgage-backs. At USAA, we were like 60–70%, which is a little bit insane. And we got out of those, but you could justify the mortgage-backs, not a huge allocation, but a 5% allocation. If you think, compared to treasuries, they'd give you a better deal. Mortgage-backs are risky because of prepayment risk and the refinancing risk. But if you don't think that risk is that high, maybe right now you say, everybody that's refinanced is already refinanced. We don't have that risk. We're getting paid pretty well for mortgage-backs. You might be able to make that. But there's usually, someone making a decision between treasuries and mortgage-backs. That's the portfolio manager making that decision. But mortgage-backs are a very, very liquid bond. Junk bonds, we saw that with Allstate. They had like, maybe 5% or so in junk bonds. It's low on the P&C side, pretty high on the life insurance side. The life insurance side needs yield. The life insurance side, they're paying, 3-4% on their annuities. They need a high yield on their bond portfolio so they can pay those annuities. The other big difference, so life insurance companies don't buy municipals, they don't buy treasuries, they do buy a lot of corporates, but life insurance companies do not buy stocks. The P&C industry does buy a fairly significant amount of stocks. And their argument has been stocks protect you from inflation, and they're worried about inflation. Now, do stocks protect you from inflation? They do a good job when it's demand pull inflation, when inflation is elevated because the economy is really strong. Stocks do well there. Why? Because everybody's buying a lot of stuff and prices going up. So yeah, corporations are seeing their costs go up, but their revenues are also going up. So the stock market tends to do okay with that. Cost push inflation that we saw in the 70s, where inflation is going up because energy prices are going up because of OPEC. Stocks did horribly in the 70s. So that kind of inflation, no, they don't do a good job. So stocks do really well with expected inflation because companies can raise their prices. Stocks are an extremely liquid security. It's very easy to sell stocks. I've done a couple of $1 billion trades and didn't move the market at all. No one even cared. $1 billion sounds like a lot of money, but it's not a lot of money. I remember bragging to Barclays about my trade. He's like, we're Barclays, we're like a $5 trillion company. We do $1 billion every 3 seconds. So I'm not all that important. All right. Both life and P&C have their wholly owned subsidiaries. You saw why that is, because that's what lawyers' solution to everything is: create another entity. So they have a lot of that. You have to essentially back that out when you're looking at them. You don't want to count that as an investment. It's especially a P&C company that owns a P&C company. It's all one big company. Fortunately, on the P&C side, they do consolidate the P&C side. And so you can look at that without all those subsidiaries in there. So that's pretty good to do. Mortgages, the P&C side does not do mortgages, especially commercial mortgages. They may do residential mortgages and mortgage-backed securities, but commercial mortgage-backs, that's not a P&C thing. Life insurers, it depends. USAA Life did almost no commercial mortgages, but they talked a lot about it because we had a USA real estate company. But they were essentially almost 100% corporate bonds. P&C side just doesn't do mortgages. It's just too illiquid. It's not a good asset for them. The life side likes it because you get some pretty decent yields. The P&C industry does not do real estate unless it's their own building that they occupy, with one huge exception. Who is that? USAA. USAA is the one P&C company. When I was at USAA, we were doing 10% of the portfolio in real estate. And we had a deal with the rating agencies that let us do that. And we said, how much are you comfortable with? And we went right to that level. And they were comfortable with 20% of our net worth in real estate, which ended up being about 10% of our assets. And we essentially struck a deal with them. They didn't like it. They thought it was too illiquid, but USA was so well capitalized. They're like, okay, we'll let you, USAA, get away with this kind of real estate. There's not another P&C company that does that kind of real estate. Now, USA's gotten really strange now. They've essentially kicked the real estate company out. And it's almost, if you any of y'all talk to the real estate people, it's almost like they don't work for USAA anymore. They're like they're in a separate building. They're in their own building. They're the first ones to move out to their own building. But they still own real estate that they invest for USAA. So they do have that. Life insurance does not do real estate either. They do commercial real estate. So if a life insurance company has an equity interest in real estate, it's because one of the commercial mortgages defaulted and they got the keys to the building. So almost all the real estate on the life side, and even on the P&C side, if they do any commercial, all of it's coming from the commercial mortgage side. So that means when a life insurance company has real estate, it's not good. They got it for all the wrong reasons because someone defaulted. So on the P&C side, you see how the liquidity comes in. you see how the inflation comes in. Now, the one thing I didn't mention was tips, and that I just do not know. Do P&C companies, are they buying tips? And my guess is they're probably buying some, but tips are not as liquid as treasuries, so they may not, they may not be doing that. So what should they be doing? You saw my idea, right? So I think they should try this. So one of y'all, when you're in the investment arm at USAA, say, hey, you can take credit for the entire idea. I got this great idea. Why don't we do this? And then I'll be happy. You can take credit for it as long as you let me know if it worked or not. Okay. Because I'm really curious. I mean, can y'all see a flaw in it? I see a flaw in this approach. Doesn't it? It looks pretty cool, doesn't it? The only flaw might be that tips, treasury inflation are still a little bit uncertain how they get priced. They may be pretty low noise. So that I can't tell you. I don't think anyone's doing that, but I think that would work pretty well. And then other. So we saw Allstate has a lot of this kind of stuff. That's that scheduled DB. Allstate does a lot of it. Allstate was the exception when I looked at all USA's competitors. I didn't look at the Hartfords and the Chubbs, the commercial ones. So I don't know what they're doing. So that's private equity. USA did private equity, but boy, it was small. I took over that portfolio, and I always tell my students, the lady that was running it, she literally had it in a shoebox, and she brought the shoebox and handed it to me, and I put it all into Excel. But I think the largest it ever got was $500 million. It's just, no one wanted to spend any time on it. I don't think, Allstate I think has some private equity, but it's probably not more than 3 or 4% of the portfolio. It's going to be a small piece of portfolio. Allstate and USA did derivatives, but I couldn't find anyone else that was doing derivatives. Joint ventures is the same as private equity, essentially, and then other. One thing you'll notice with Allstate and you'll notice with USAA is the securities lending side, but you can kind of ignore that. I think almost everyone's doing that. So bottom line for P&C companies, heavy on municipals for tax reasons, heavy on treasuries and agencies, maybe a little mortgage backed. Why? For liquidity. So you got taxes, liquidity, because it's P&C side. Life insurance doesn't do any of that. I mentioned securities lending. They love treasuries and agencies because they don't have to sell them. They can just lend them out and get all that cash. USA did a lot of that, and we tested it too. We would do 300 million just to make sure it worked. Heavy in corporate bonds for the yield, but not as much as the life inside. Small exposure to junk bond. They just don't like that. Again, it comes back to junk bonds are very illiquid securities. You don't want to be doing a fire sale on junk bonds. Stocks for inflation. But that's it. Taxes, liquidity, yield, inflation. That's what they're doing. Everybody's doing their own thing. There was a large insurance company here in town, and a friend of mine went and worked for them. And he said, I had my consulting business there. He was tempted to hire me, but I think we overpriced it, so he didn't call me back. But he was telling me what they were doing. I was like, I can't believe y'all are doing that. That's ridiculous. They were making decisions because some guy on the board had some brother-in-law that was, and it was like, I can't believe a firm your size is making those type of political decisions. It was like, I don't want to hear this. And he was the CFO of this company. I was like, yeah, you need to, I'll come in and do it for free for that. I mean, that's just ridiculous that you have a firm. That's just, you shouldn't be doing stuff like that. So they should be making a decision, for the stockholders, and also be as competitive as you can be. So that yield is the competitive side, right? You need the yield so that you can make more returns, so you can reduce your premiums. For tax reasons, competitive as well. You want the highest after-tax return you can get. You want to be competitive, but you have to recognize that you have a business that can blow up at any time. So, and you have a business that's sensitive to inflation. So it's pretty easy. I mean, if you brought this up in an interview, you would be in pretty good shape. A good friend of mine interviewed for the insurance company, and he didn't do well. And he's telling me the questions. I was like so jealous. I want to do the interview. It's like, I don't even want the job. I just want to do the interview because I'd studied this for so long. But anyway, so this if you know this, you know more than 99.9999%, because there's just not much study on this side. All right, so what are we going to do on Monday? We'll talk about the exam. I'm going to highlight a few things on the regulatory side because it's really important that you know it. There's no class on Wednesday. We're having a debate about that earlier, but it's real clear on UTSA.